How's it going? Welcome back, it's Jonathan. Now in this video, bad news. The editing software I use has removed my drawing tool, so I can't draw on the screen in the way I used to. But what we'll do is we'll get through it, alright? So with this lag that I've got on my virtual PC at the moment, just bear with me. I'll just use the built-in pencils tool inside Optima to try and get to what I'm getting at today. Alrighty, so let's just do a recap on what we've been through, where we're coming from. That way we can take a look at where we're possibly going to go to. Now this little price target that we had around here, around the 36,000 mark, has been hit, and the market actually did push through this surprisingly. So it actually pushed through it, and what was interesting was that as it pushed through it, what happened is that the market actually came and it actually came down to one of the other price levels that we had. So this is dating back to September. Oh, losing it. Anyway, so that's what it was. So it's actually come down from a price level that we had looked at back in September as a potential secondary for this market to decline, and it actually came into it this time. So that was interesting to see. I'm not saying that you know, that's what we should have been looking for, because it did come down into an area that we were watching for anyway, so that's totally okay. But there's a few things that I need to point out, and first of all, I think what is important to begin with is that as the market is falling, so as we can see the market is actually coming down, what's actually important is that the VIX Fix for this period, and I'm saying important, but I really should be saying like interesting, or what's interesting. The market is declining and the VIX Fix is actually hovering around this midpoint here. So the fear in the market isn't as high. It definitely is not as high as it was back in May. And you know, I might be the only one to suggest this, but I don't think that the end of this run is over. And you're probably thinking, wait, so we're still in a bull market? No, actually, I mean the end of the run to the downside, I don't think that's over. Now I could be wrong, but the forecast actually suggests that there is potential for another low to occur in the future. And obviously I've just jotted in this random line here, this random circle, sorry. And this is just a time period that I might be watching in the future for a potential low to occur in the market. So there is every chance that this VIX Fix could hit that, you know, above 45 period on the fix, which would send it into like, you know, mass fear in that instance, where we sort of got the market sentiment back in May and June. If you're around that period, you could definitely feel the market at the time was very, very, you know, fearful of what could happen. You know, the market's going to crumble, etc. I would like it to come up into this period up here. I think that is probably more beneficial and more in line with where I believe we are in the cycle. But if it doesn't, that's okay. We're not here to call everything. I'm just pointing out my opinion and giving you an idea on what I'm looking at, what I'm seeing. So that is one thing that's interesting. I think that we should all be watching that. Let's go ahead and take a look at the swings. Okay, so we had continuous lower breaks on the 1-day chart. That market has pushed higher on a swing. On the weekly, we still have a swing low. So again, the weekly is bearish. The day could, you know, I don't have the ability to draw on this one. The day could, you know, put a higher swing in before moving up. It's a little unsure of what's to look for just there, so we'll just keep the daily in mind. The weekly for the Kagi chart is still pointing down. The daily one has ticked higher. Again, red is bad, green is good. So as you can see with the Kagi chart, it helps you get in the trades early on, and it helps protect you when the market turns. So if you would have bought around $46,000 and sold it over here when the Kagi chart turned red, you would have seen that you would have sold it around that, you know, with at least within that 40,000 point range. Sure, you wouldn't have sold the top, etc., but it helps to protect your losses, from you against losses, I should say. And also with the gains, you know, you can't take gains out of the strategy. I'm not saying that every single time you're going to, you know, lose money or make money. I'm just saying that the Kagi chart is a freaking awesome strategy to be buying into the market when it turns green, because it can indeed protect those losses and maximize those gains. So if you just look here, I'm just trying to find a losing trade. Okay, good. So as you can see, this one here, we had the buy signal issued at around was that around 11,500. and then the actual sell signal was around 9,000-ish, so 10,000 to 9,000. So you know, it's not a guaranteed trading strategy, but I just would, you know, remain on the side of the market where the Kagi chart is green over being the Kagi chart red. Okay, now if you look at the daily swings, yes, the daily one is definitely like choppy, in and out, in and out, in and out. But if you're going to trade the weekly swings, this is where I believe that the most money can be made in the shortest amount of time, because the daily swings, yeah, you might be in and out of the market a few times here and there, but over the daily swings, you know, look at this choppiness. You got multiple trades occurring, multiple losses. But when you look at the weekly chart, you can definitely see it's a different ballpark. I didn't want to waffle on too much today because there are just a few things that I wanted to point out. We're just going to continue on with our, you know, outlook for the bear market, or a potential bear market. And it really comes down to this move right here. So at the moment, there's going to be two things I'm going to do right now. So you're going to take on the price measure. I'm going to measure the top to the bottom. That was a 54% loss, or $35,000 loss. Let's do the exact same thing. And we'll just pop it over here. Alright, so we got a 52.3% loss and a $36,000 loss, okay? So regarding the points range, these are both very similar in decline. So this could indeed be a low, or a low at least in the meantime, for this run down. But what's important, in my opinion, is that we don't get more than 11 bars down. Okay, so if we get 12 bars down, this is what I was getting at the other day, the 12 bar run. If we get 12 bars down in the direction of this trend, so this trend right here, the one that's going down, that could be detrimental. So at the moment, this here is the 11th bar, and any move in next week onwards below this bar would actually, you know, would constitute a downtrend, and it would signal that, I'm not saying guaranteed, but it would signal that the bias to the downwards move is stronger than the bias to the upwards move. So again, if we look between this period, you got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So the 10th bar is the lowest, 11, 12, 13, 14. This 14th bar is actually higher than the 10th bar. Once you get bar 12, so this one here, bar 12 or onwards in this period, move below the lowest low in that run between 1 and 11. In this case, it was 10, if that makes sense. Then that would signal a downtrend. That never actually happened here. But now we're at bar 11, so that means bar 12 or more in this period here could trigger a downtrend. Now, ideally, we get a low in March. That would be the ideal situation, because that would tell me that we're on track still for the forecast, and the 2022 roadmap would still be in play. I'm not saying it has to be that way, because as you can see, if we go back to last year's, you know, mass pressure chart for last year, we can definitely see that things don't play out exactly. We need to interpret the data as it comes. So that's what's we need to consider as well. Now, in saying that, this point is critical. So we need to just watch it. We need to keep our eyes on it. We do have a 35,000 or 55% and a 36,000 or 52% point drop and percentage drop, which is an equal in price. So that could prevent this market going low, at least for the time being. But if we get a low in March that is above this low here, then this low would have been the low. If we get a low, you know, in the future, in the next, you know, 30 to 60 days, that is below this low, then the market could definitely continue falling lower, just for a little bit longer before it finds its final low and the market reverses. Again, I'm not bearish the whole year. I'm bearish the first quarter and the second quarter. I believe there's going to be some good buying opportunities for what could eventuate in the third and fourth quarter. Now, again, if you want to unlock those roadmaps, if you want to see what, you know, what I'm looking at, what potentially could occur in the future, you need to just get in the back end. It's very simple, very simple process. You just go ahead, click the link below. That link will take you to the order form, and you can do two things. You can join our back-end access for free, and that'll give you the dates for the year, or you can join our paid back access group, and then that'll give you the actual roadmap for the year. So those are the two options you have. You can choose whichever way you want to go. It's entirely your choice. Now, with respect to the daily, the market has fallen around 87.5% as well. We did find some congestion around this area. Sure, it broke through, it never closed below it. 87.5 is an important Gann number as well. So that's 87.5 is, in my opinion, the equivalent of a 90% decline in the market, or, you know, drop of 90%. For a lot of traders who look for that 90% level, 87.5 was very important for Gann. So 87.5 to 90, it's only a 2.5% difference. So you consider that being a 90 mark. I think it's important. Gann thought it was important, so we should think it's important too. So this run definitely could be over to the downside, for the next few days. But I think the bias still, that's just my opinion. I think the bias still is to the downside. All right, so let's move on. All right, so if we just take a look at this market formation right here, I just wanted to highlight, a potential 90% decline. That would have been on the cards for your general bear markets. Okay, so if the market did decline 90% like it did in the past, which I don't think is going to happen, that would actually take us back down to around that 8,000 point mark. That would also put Bitcoin. Let's go ahead and just move this to 90 if I can get it. There. So that would also put us in at around 62,000 loss. Now I don't think that Bitcoin is going to fall that far. I think that this year is going to be the year that makes a lot of bulls correct, and it also makes a lot of forecasters like myself potentially correct in our analysis. And the reason for that is because the bulls are still in, and the bulls are saying, look, the market's not over, blah blah blah. We've still got an end of cycle push higher to occur. Now, if the market doesn't fall 90%, well, that would automatically make them correct. But I think what's more important to that is understanding that I don't think this cycle is going to see a 90% decline, mainly because of where we are in the longer 18.6 year cycle, which I've spoken about in the past, which sort of gives me the understanding, or I guess the hypothesis, that the Bitcoin cycle, the real estate cycle, the 18.6 year cycle, and the stock market cycle, they're all going to be syncing up into the last push that will put us at one of the greatest bull runs of all time as we move into the second part of the cycle. Now, generally speaking, technology stocks do not perform well in the second part of the cycle. So if we are indeed aligning up and moving into the second part of the cycle, whilst I believe that the technology behind cryptocurrency is extremely bullish, historically speaking, tech stocks in general have underperformed in the second part of the cycle, unlike they have in the first part of the cycle, where they're very, very bullish, as we saw in 2013, 2014, and into the run in 2017, 2018. Okay, so we saw those massive booms. So we got to keep with a grain of salt that, yeah, sure, some people are calling $1 million Bitcoin by 2030. We might not get there just as in the same fashion that we had in the past, where we are doing those 20x's, 30x's in the markets. So just something to consider. Now let's move on to seasonality, then we'll wrap it up. So as we can see, we're way below where we should be generally seasonality wise. I think that this is going to be an anomaly that pushes on for at least another 2 months because of our first quarter potential bear market that we were looking at. Again, if you want to know what's going to happen in April, May, June, July, etc., go ahead and download that forecast, because that forecast is going to give you the keys to the year. And so far, I've got no reason to believe why the market hasn't rhymed to what it would normally rhyme to in the past, simply because I'm looking at cycles that no one else is looking at, or no one else fully understands how to look at. And that's purely because I built this cycle. So I went through all the data, I built the cycle, and I back tested the cycle over the whole period that Bitcoin's been out for, especially during 2016, 2017, 2018, 2019, and 2020. And I found the rhythms that Bitcoin was moving in, and all I did was reapply that to 2022, which no one else did. And as we can see, it was the best call. So anyway, I'll just leave that to you. Just wanted to, show my face again, my beautiful face on a day like this. And yeah, the last turn date was the 25th. The market did bottom on the 24th. There's another one coming up in around 2 to 3 days. So let's go ahead and see if we get another low around there, and then we could be pushing higher. If we get another high around that point, then we could be pushing lower again. So we just want to move in and out of these turn dates. Again, you can download the turn dates for free in the description below. And we just want to move in and out of these turn dates. And then what we want to do then is build the case for Bitcoin. And I like to say this because it's the best way to say it. Tops are bad, bottoms are good. So the more dates we get on the bottoms that turn the market and push it higher, the better. So this whole run, a lot of the tops were turn dates, okay? So a lot of the tops we'd calculate as turn dates, and that's not a good sign, okay? So yeah, that's all I got. Talk to you soon.